They never learn. That is the first thing I want you to understand. Not because they lack intelligence. Many of the men I watched get destroyed on the tape were brilliant men, educated men, men of considerable means and sharp minds. But the market does not care about your intelligence. It cares only about your behavior. And behavior, when money is involved, is almost always rooted in emotion. And of all the emotions that have cost traders their fortunes, their reputations, and sometimes their very will to live, greed is the most relentless executioner of them all. I have spent decades studying the tape. I watched fortunes built and I watched fortunes dissolved, sometimes in the same afternoon. I saw men who should have walked away wealthy instead give everything back because they believed the move had more left in it. They believed because they wanted to believe, and the market, cold, indifferent, mechanical, simply obliged them. It gave them just enough rope. Before I go any further, I want to point you to two resources that I believe will transform your approach to the markets. The first is Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. You will find the link in the description below. The second is The Livermore Journal, a 90-day trading psychology workbook, also linked in the description. These are not books of tips and tricks. They are books about the architecture of a trading mind. Read them, study them, apply them. Now, let us continue. The chart pattern I am going to describe to you today does not have a fancy name. It does not need one. It has existed in some form since men first began speculating, in cotton, in grain, in railway shares. I saw it destroy traders in my era, and I have no doubt it is destroying traders in yours. The setup is almost always the same. A stock, or whatever instrument you are trading, makes a powerful and convincing advance. Volume is strong. The news is favorable. Everyone is talking about it. The public begins to notice. And then comes the greed. You see, the early buyers and the professionals, the smart money, the men who took their positions quietly and patiently when nobody was paying attention, they are now sitting on substantial gains. They are not celebrating. They are preparing. Because they know what you do not yet know, that the best time to sell is when no one else wants to. The best time to sell is precisely when the crowd is buying with both hands and demanding still more. I have discussed the principles of this in our previous video on how smart money accumulates positions. If you have not watched it, stop here and go watch that first. Understanding accumulation is essential to understanding the trap that is being set in the chart I am about to walk you through. The link is in the description. Go, watch it, come back. This video will wait for you. Now, back to our pattern. After the powerful advance, after the euphoria, after the volume surge and the breathless headlines, the stock pauses. It does not collapse. It does not even look alarming. It simply consolidates. It moves sideways for a period. The public interprets this as the market catching its breath. The optimists say it is a healthy pause before the next leg higher. And you know what? Sometimes they are right. That is precisely what makes this pattern so lethal. Sometimes the pause is innocent. But the version I am describing to you is not innocent. The version I am describing to you is a carefully constructed ceiling, what the tape readers of my day called a distribution zone. During this sideways movement, something critical is happening beneath the surface. The professionals, the ones with large positions, are offloading their shares, not all at once. That would break the price and alert the crowd. No, they are selling patiently, methodically, into every small rally, distributing their inventory to the eager buyers who are convinced the big move is still ahead. The chart looks calm, the chart looks constructive, but the chart is a lie dressed in the clothes of opportunity. And then comes the breach. At some point, triggered by news, or by some internal exhaustion of buying demand, or simply by the invisible hand of the operators who now have no more interest in supporting the price, the stock breaks. Not a gentle drift lower, a break, the kind of price action that sends a cold shock through the nervous system of everyone holding a long position. And in that single session, sometimes in a single hour, weeks of gains are erased. I want you to think about who is on the wrong side of that break. It is not the professionals. They sold during the consolidation. It is the latecomers, the greedy ones, the ones who saw the advance and said, "I missed the first move, but I will catch the next one." They are the ones holding the bag. They are the ones frozen, hoping for a recovery that will not come fast enough. and in their panic, they become the fuel for the next phase of the decline. Now tell me, does this sound familiar? Drop your answer in the comments below. Tell me, have you ever been caught on the wrong side of this pattern? Have you ever bought into what looked like strength only to watch the floor disappear beneath you? Comment below. I read every single one. There is a version of this pattern that I considered the most dangerous of all, not because it is the most dramatic, but because it is the most deceptive. I call it the false breakout variation, and I have seen this one in particular destroy men who should have known better, men who had survived the markets long enough to develop a certain confidence, and confidence, as I have said many times, is one short step away from arrogance, and arrogance in the markets is always punished. In the false breakout, the stock does not simply pause and reverse. It first gives you hope. After the long consolidation, the price appears to break upward. It exceeds the previous highs, sometimes only slightly, sometimes by a more convincing margin. Volume picks up. The charts flash green. The momentum traders pile in. The breakout buyers trigger their entries. And for a brief, intoxicating moment, it looks like the next great advance has begun. It has not begun. What has begun is the final act of the distribution. That breakout above the highs was engineered. The operators, those with the largest positions and the deepest pockets, pushed the price just far enough to trigger the buy orders that were sitting above the consolidation range. They needed buyers. They needed volume. They needed someone to sell their remaining inventory to. And so they manufactured one final rally, one final surge of optimism, and then, once they had unloaded the last of their position, they stepped away, and without their support, the price collapsed back below the breakout level almost immediately. The traders who bought that breakout are now trapped above the old resistance, which has now become new support, a support the price will not honor. Their stop losses are just below the breakout level. As the price retreats and those stops begin to hit, the selling accelerates. One wave of forced liquidation triggers the next. What looked like a launch pad has become a trapdoor. I discussed the mechanics of stop placement and why most traders set their stops in exactly the wrong places in our video on pivot points and key price levels. If you have not yet watched that video, I urge you to do so after this one. Understanding where the crowd places their orders is essential to understanding why the operators are able to exploit them so predictably. That video is linked in the description and on the channel. Now here is what separates the traders who survive from those who do not. It is not intelligence. It is not even experience, though experience helps. It is the willingness, the genuine, deeply ingrained willingness, to sit on your hands when the crowd is screaming at you to act. Every instinct you have, every social pressure around you, every headline and commentator and market participant in your vicinity will be telling you to buy. And the discipline required to look at all of that noise and say, not yet, the pattern is wrong, the risk is asymmetric against me. That discipline is earned through pain. I wish I could tell you otherwise, but the market is a school that charges tuition in real money, and the lessons are not gentle. What are the signals that distinguish a genuine consolidation before a move higher from a distribution zone preparing for collapse? I will give you the framework that served me throughout my career. First, watch volume during the rallies within the consolidation. In a genuine accumulation or resting phase before a continuation, volume on the upswings tends to be stronger than volume on the pullbacks. The buying pressure exceeds the selling pressure. But in a distribution zone, you will often observe the opposite. The rallies are thin, unconvincing, low-volume affairs, while the pullbacks carry heavier volume. The market is telling you something. You must learn to listen. Second, examine the character of the price action at the highs. In a healthy market, each attempt to test the highs should show some willingness to move through them, or at minimum, to hold near them. In a distribution zone, you will often see what I described as churning, days of high volume and wide price swings that begin and end near the same level. The market is working hard and going nowhere. That is not health. That is exhaustion. The market is absorbing enormous supply, and it is struggling under the weight of it. Third, respect the time dimension. I have always believed that time in a market structure is as important as price. A consolidation that extends for weeks, that outlasts the patience of the initial buyers, that begins to feel tedious and unresolvable. These are often distribution phases in disguise. The public grows bored. they lower their guard, and it is precisely when they lower their guard that the trap is sprung. If you find these frameworks valuable, and I believe you will, then the ebooks linked in this video's description will give you an entire architecture of thinking built on these principles. Thinking Like Jesse Livermore and The Livermore Journal, a 90-day trading psychology workbook, are designed not merely to teach you patterns, but to rebuild the way your mind processes risk, opportunity, and discipline from the ground up. The link is in the description. Do not let another losing trade happen before you have read them. Now, here is the part that matters most. Here is the part where I ask you to do something that will feel deeply uncomfortable. I am asking you to accept the possibility that the trades you are most excited about, the ones that feel most obvious, the ones that seem richest with potential, are precisely the ones most likely to be traps. I am not asking you to become a cynic. I am asking you to become a student. Cynicism sees danger everywhere and acts on nothing. Discipline sees danger clearly, evaluates it honestly, and then, when the conditions are genuinely right, acts with full conviction. That is the difference between a man who lasts in this game and a man who is eventually carried out of it. Let me tell you about a trade that nearly broke me. Not financially. At that particular moment in my career, I could absorb the loss. What it threatened to break was something far more important: my understanding of myself. It was a stock that had made a magnificent advance. I had observed it carefully. I had let the early move go by without participating because I was not yet certain. When it began to consolidate, I watched. I noted the volume. I noted the price behavior at the highs, and I told myself I was being patient. But patience, when it is prolonged, can curdle into something else, into hunger. And hunger, even when it wears the mask of patience, is still just greed in a more sophisticated suit. When the stock finally appeared to break out above the consolidation range, I acted. I convinced myself the analysis supported the entry. I told myself the volume was adequate. I told myself the timing was right. But if I am honest with you, and you deserve honesty above all else, the real reason I entered was because I had been watching the stock for so long that I had developed a relationship with it. I wanted it to work. And desire, in the markets, is a form of blindness. The stock reversed within 2 sessions. The breakout was false. I was trapped precisely where I had watched so many others get trapped before me. And as I sat with that position, watching each day peel another layer off my initial entry price, I had an experience that I believe was among the most valuable of my trading life, because I was forced to confront, in the most visceral and immediate way possible, the truth that I had been preaching to others for years, that knowing a principle and living a principle are 2 entirely different things. I took the loss. I took it cleanly, without hesitation, the moment the evidence was unambiguous. And then I did something I recommend to every trader who has just suffered a meaningful loss. I stepped away from the tape entirely. Not forever, not even for long, but long enough for the emotional residue of the loss to settle, so that my next action would be made by my rational mind rather than by my wounded pride. This is the heart of what the Livermore Journal, a 90-day trading psychology workbook, is built to address. Because the losses are not the enemy. The losses are the teachers. The enemy is the mental and emotional response to those losses that leads you to abandon your discipline, double down irrationally, revenge trade, or simply give up. The journal is a structured daily practice for building the psychological resilience to absorb losses, learn from them, and return to the market stronger. It is in the description. Use it. I mean that. Now I want to speak directly to those of you who recognize yourselves in what I have described today. The ones who have been the greedy trader, the ones who have bought the breakout that was not a breakout, the ones who have held through the distribution convinced that the next rally would save them, the ones who have added to a losing position because the alternative, admitting you were wrong, felt worse than the financial pain. I want you to understand something that took me longer than it should have to truly absorb. Being wrong is not the problem. Being wrong and refusing to act on that wrongness, that is the problem. The market does not care about your ego. It does not care about your previous track record, your credentials, or the reputation you are trying to protect. It only cares about supply and demand, about the aggregate behavior of every participant, and about the relentless arithmetic of price and time. The sooner you separate your identity from your trades, the sooner you will trade like a professional. And here is what the professionals understand that the crowd does not. The chart pattern I have described today, the distribution, the false breakout, the collapse, this is not a threat to be feared. It is an opportunity to be exploited. When you can recognize the signs of distribution, the churning volume, the thin rallies, the false breakouts, you are no longer the prey. You become the observer. You become the trader who steps aside while the crowd rushes in. You become the trader who waits for the collapse and then, from a position of clarity and patience, identifies the true opportunity on the other side. We have covered the technical signals of distribution in our video on reading institutional footprints on the chart. If you have not seen it yet, that video is on this channel, and I strongly recommend you watch it immediately after this one. It will show you precisely how to track the behavior of large participants in real time. That knowledge, combined with what we have discussed today, gives you a framework that most retail traders simply never develop. Let me leave you with this, and I want you to hold it close because it is the most honest thing I have ever said about trading. The market will give you every opportunity to become wealthy, and it will give you every opportunity to destroy yourself. What determines which path you take is not luck. It is not timing. It is not even skill in the narrow technical sense. It is character. Character is the ability to sit still when everything in you screams to move. Character is the ability to cut a loss when every emotion insists that it will come back. Character is the ability to let a winner run without leaning over it like a hawk, terrified that the gain will evaporate. Character is built slowly, painfully, through the accumulation of experience and reflection, and it is destroyed in a single moment of undisciplined greed. The chart pattern I described today, the distribution, the trap, the collapse, is not merely a technical phenomenon. It is a psychological phenomenon. It exists because human beings are predictable in their greed and their fear. The operators of every era have understood this. They have built their strategies around it, and they have profited from it reliably, decade after decade, because the crowd never changes. But you can change. That is the extraordinary, uncommon, deeply empowering truth that I want you to walk away with today. You are not obligated to be the greedy trader. You are not obligated to be the one holding the bag while the professionals count their profits. You have access, right now, in this moment, to the frameworks, the psychology, and the discipline that separate the losers from those who endure. Go and read Thinking Like Jesse Livermore. Do the work in the Livermore Journal. Watch our other videos on this channel. They are built as a complete education in the methods and mindset that have stood the test of time. Every video we have published is a piece of a larger map. Follow the map. And now, I have a question for you. Drop it in the comments and let us have a real conversation. What is the most expensive lesson the market has ever taught you? Tell me. Tell the other traders watching this video. Because every honest answer posted below is a piece of wisdom that might just save someone else from paying the same tuition you did. Comment, share, and if this video moved you, if it shifted something in your thinking, then share it with one trader you know who needs to hear it. The tape never lies. It is only our willingness to read it honestly that fails us. Go and learn to read it.